Okay, we're starting lecture 3 of week 3. We're going to be looking at the cash flow statement. Okay, one of the mysteries of the cash flow statement is that it's really trying to gauge where your money's coming from and going to. And quite often it might not have anything to do with the actual sales or net income. And we see this with business owners at the end of the year. They may say, well, gee, you know what? I had a profit of $100,000, but I've only got $50,000 in the bank, or the other way around. I had profits of 10,000, I've got 50,000 in the bank, or even worse, I had losses of 10,000, I've got 50,000 in the bank. So these are the sort of things that the cash flow statement is designed to look at um, and give you a quick analysis on it. Or better yet, word yet would be a picture, just to give you an idea where your money has come from and gone to. As well, a profitable company might be selling a lot of goods on credit, in which case the customers might have your money even though you've been profitable. Or you might have some expenses that you've built up before you've actually done some sales. Another thing to look at. Or you might be buying a lot of assets or having quick growth that causes money to be tied up in things like inventory. Okay. Now, accrual accounting tries to match revenues and expenses, and a lot of times the cash flow doesn't happen at the same time. We're primarily concerned with cash flow because you need to pay rent, employees, and utilities. Not many employees on come Thursday afternoon are going to say, yeah, I'm happy if you hand them an IOU. You hand them a note that says, oh, glad you pay you in a couple of months. Doesn't work that way, and they usually go somewhere else, and doesn't make for a good reputation of a company. So that's why we're so concerned about the cash flow. Here's a quick example of cash flow versus accounting. For instance, we have earnings before interest and taxes, so we got $1,000 coming in. Theoretically, we got $1,000 coming in cash flow. Take out the amortizations, $100. So your earnings before taxes is 900 minus the taxes of 400 gives you a profit of $500. Okay, so it should say we've got $500 in the bank, but our cash balance has only gone up $150. We should have 500 extra actually. Well, if we bought some equipment for $300, we paid off some debt, okay, for $150, and we add amortization back in because we didn't actually write a check to amortization. Our cash flow is going to be up $100. So if we take 500 minus 300 minus 150 plus 100, then our cash flow is actually to the good by $150 instead of 5. Okay, now cash flows in the accounting sense, we divided it up into 3 areas. Okay, one would be operations. Okay, cash paid and received from buying and selling goods and services and the other things that we do to run the company. Investments, okay, cash paid and received from investing activities. Okay, maybe we're buying property, buying equipment, that sort of thing. We're not going to cover selling of long-term assets in this course, so we'll just say buying right now. Financing, okay, if we get money from financing activities, if we sell some shares or get a loan, something like that. And then to do with financing is if we pay the shareholders some dividends, et cetera, mortgages, etc. We consider that financing. Okay, financing. Now, notice in the financing, we don't deal with the interest on the loan. We pay off the capital on the long-term debt, but the financing sources and uses of cash, i.e. the interest, is actually covered in the operations. One of those funny things, but it's going to be the method we use that's going to dictate that, makes it easy. Okay. Just as a quick note, when accountants put things in brackets, it usually means that it's the negative of the previous word. Now, sometimes it's just a sentence, but if we go back up to the title of the slide, sources and in brackets, uses of cash. So sources would be an in, uses would be an out. That's what we're talking about when we talk about brackets. Okay, profit is no brackets, loss is brackets. And that concludes our lecture 3. Thanks.